Fullerton has become more concerned about weaker growth and high inflation. The investment environment has become more challenging as markets have corrected sharply, earnings growth is slowing and interest rates are rising. Fullerton's proprietary global growth indicator has just turned negative, and these headwinds will be reinforced with weaker risk appetite and tighter liquidity. The most concerning downside risks to growth remain in China, as the real estate sector has had another leg down and as economic activity is under pressure with the COVID lockdown policy. China's most recent policy announcements may have provided a floor to markets, but we believe bolder actions will be needed if growth is to recover toward the target of 5 to 5.5% this year. The prospect of inflation being too high for too long may accelerate the slowdown in growth as households postpone their spending and as firms cut output to try and contain costs. But more importantly, high inflation has increased the risk that tighter policy could eventually cause a slump in growth. That becomes more likely if the highly leveraged economy proves more sensitive than expected to rising interest rates. So in navigating challenging markets, managing the downside risk is prudent with the aim of being well positioned to take advantage of opportunities once the headwinds fade. So investors should remain active as equity growth assets and real estate have favourable long-term trends that can outperform inflation. Global markets are differentiated, which should continue to provide selective alpha opportunities across different sectors and countries. So for example, the US may remain the strongest market given its growth and productivity is still above trend. In contrast, Europe faces greater headwinds from adverse stagflation, while Asia faces greater risks of a hard landing in China. We continue to favour sectors like consumer products, communications, healthcare and renewables as they seem well positioned to withstand this challenging macro backdrop.